Hey traders, welcome to the very first session of the UTG Beginner Crypto Trading Series. It's Tex here with you, and today we're going to run you through TA and candlesticks. But before I start, I want to say a big welcome and a huge thank you for taking time out of your day to come and join us while we help you out with these beginner trading conundrums. Because I don't know about you, but when I first started trading, there was so much information out there, but I didn't know what to digest. I didn't know where to start. It's long before Discord came along, or I knew about Discord for crypto related channels. We were still chatting it up inside some Facebook groups. And sometimes when you ask a question, you feel like a bit of an idiot because of the responses that you get from people. It's kind of like, well, duh, you should know what a trend line is or a support and resistance is, you idiot, get out of here kind of thing. And that's why we started Unity Trading Group, to really help struggling traders find a place where there was support, there was encouragement, there was a motivated environment where anyone could ask a question without judgment or any of the bullshit that goes along with it, that toxicity that we see so much in the space. And we're really, really excited to share this with you. So thank you so much for being here. So let's get into it. Over the coming weeks, we're going to tell you everything you need to know about beginner trading advice or beginner trading information. This is the guide that we wish we had when we started out. There's no reference links. There's nothing in here. It's all completely free. And we get questions about beginner strategies all the time. And we thought, well, why the hell wouldn't we just put something together? So that's exactly what this is. So let's get into it. We're going to start with the very, very basics. UnityTradingGroup.com if you want to join us on Discord, if you are watching this somewhere else. And we've got a channel completely dedicated to you as beginner traders, where you can watch these videos, come over and ask questions of Ads, Don, and I, and all our members in the community, and let's answer those questions and get you to a point where you are confident with your trades and killing this market. And if any of this doesn't quite sit with you well, remember, we've got so much more content to come. Digest and absorb this info, and then come back next week for our new bit of info. All right, so what is trend analysis? Well, that's a pretty simple one. Trend analysis is a technique used by traders in order to predict the future price of a coin, an FX pair, or a stock movements based on previously seen trend data. It's really based on the idea that what has happened in the past gives us an idea of what happened in the future. Now, while markets don't repeat, they often rhythm and rhyme, is the saying. So what you've seen in the past, there's a good chance you may see the same type of movement in the future. There are three main types of trends. There's a short-term trend, there's an intermediate-term trend, and there's a long-term trend. And trend analysis encompasses all the information we're going to show you over the next 7 weeks using indicators, types of support and resistance, trend line, the whole kit and caboodle. We're going to share it all with you, and it all falls under this umbrella of trend analysis. That's what this image represents here. Are we going down? Are we going up? We see some information here that might help us in the future, perhaps, to show us where price might be headed. I showed us the price was going down, and look at that, it's happened again. So this information to the left can help us with information on current time periods. That doesn't make sense? That's cool. We're going to show you all this over the coming weeks. Let's just tick along for now. So what are candlesticks? This is the next part of the puzzle, and you can see candlesticks here. These are your candlesticks, and we'll get into that. So candlestick charts are a type of financial chart for tracking the movement of a coin or an FX pair or a stock. They began in the Japanese rice trade, now also have their place in today's charts. They are that old, have been around for a very, very long time. This is proven strategies. This is proven information. Most traders find them more visually appealing than the standard bar charts, and the price actions easier to interpret. So candlesticks are called candlesticks because they look similar to, well, yeah, candles. And over time, the candlesticks group into patterns that we can use to make buying and selling decisions. And each candlestick represents price data for that given time period through 4 pieces of information. And what do I mean by that before I continue on? Well, let's just dive back to this chart real quick. If this was a 4-hour chart or a 1-day chart, each of these candlesticks represents 4 hours or 1 day or 15 minutes or 5 minutes. God forbid you're trading on that as a beginner trader. We would sort of recommend 4 hours and above for beginners to trade on. It takes a little bit longer for things to play out. So each of these candles represents that time period, 4 hours, 1 day, 30 minutes, you get it. And it contains 4 pieces of information, the candles: opening price, closing price, the high price, or the low price. And a disclaimer, of course, use candlestick charts like any other technical analysis tool, but realize they're not the be-all, end-all. It should always be used in conjunction with other indicators and fundamental analysis to confirm your bias. This is not trading advice. All right, candlesticks 101. This is what you're going to see on your charts. This is what we saw on the chart above before. So let's break it down. What is a candle? So we can see here we've got bearish candles. Red, this means we're going down. Stop. Red means stop. Green means go. So bullish and bearish. Bullish means the bulls are in control, the buyers are in control, and we're going up. Bearish means the bears are in control. We're going down. So this is what traders want to see. More of these puppies, less of these. So as we break it down, we've got the high. So this means this is where the price was. So if this is a 4-hour candle, this is how high the price got in that 4-hour move. Same again for bullish. You can see what this is. This is an upper wick because it looks like a wick. Got the lower wick. This is the lowest the price came. So for example, this was 20 cents and this was 10 cents. This means within this candle, we got to 20 cents, but the lowest price within that 4 hours was 10 cents down here, for example. And this is called the real body. This is the body of the candle. This is the wax, and these are the wicks. So this is where it opened. This is where it closed. This is where it opened. This is where it closed. If it doesn't make sense, it's okay. Come and ask questions. We'll talk more about it. So as bulls, as someone who wants to see things go up, we want to see more of these green candles. So we want to see bullish reversals, which means that things were going down and now they're coming back up again. We want bullish reversals in candles. And just like red means stop, green means go. And green candles represent bullish price action. That's good, going up, price action. Price action means movement, which means that the price of a given coin is going up, but until it's going up until it hits a level of resistance and starts to move down. What is resistance? Stay tuned for more videos. We will explain that in depth. Bullish reversal patterns should form within a downtrend. Otherwise, it's not a bullish pattern, but a continuation pattern. So say, for example, we've got a candle and it's going down. Let's go back a little bit. So we've got things are going down. This is bearish. Things are not good. Look what we've got here. We've got two pretty big green bull candles and then bullish action. Got the bear. So if it were to continue down, but we saw some green candles here and we continue down, that's a continuation pattern. It means we're still in this downtrend until we see some good positive upwards trend. Some greens means we're going up. Hope that makes sense. Come over to Discord if it doesn't. So most bullish reversal patterns require bullish confirmation, which means, in other words, they've got to be followed by an upside price move, which can come as a long candlestick or a clear move up and be accompanied by high trading volume. So what we had here, this is a clear move up. We had these big green bull candles and then another big green bull candle and more green bull candles over this time period. So we were trending up. That's a confirmation that we're going up until such time as we hit resistance and we come back down. So let's have a look at some examples of bullish formations. You're not always going to see this type of stuff. It's not like every single candle you see is going to be represented by these formations, but this is some of the common things we look for as traders on a chart. This is a hammer. Obviously, it looks like a hammer, doesn't it? Thor's hammer almost. So the hammer candle means that a coin is almost at the end of its downtrend and things may be about to change. The body of the candle is short with a longer, lower shadow, which is a sign of sellers driving price lower, only to be followed by strong buying pressure to end on a higher close. So as we can see here, this was the closing price and the opening price. So we may have opened at, say, 10 cents here, and the sellers have driven it all the way down to like 4 cents. So that would have been a big red candle at that point, but the buyers have gone, nope, stuff you. We're buying this back up. So they've bought all this back up, and then this is where we've closed. So before we jump in on the bullish reversal action, we've got to confirm the upward trend by watching it closely, because the reversal has also got to be confirmed with an increase in buying volume. It means there's got to be more people buying this than selling this to drive the price up and to close on a high. Buying volume, not quite sure what that means. Stay tuned for the coming weeks. We're starting small here now, remember, very small. If it doesn't make sense now, it absolutely will in the coming weeks. So a bullish engulfing, this is a good one. So the bullish engulfing pattern is a 2-candle reversal pattern, and the second candle completely engulfs the real body of the first one. A bullish engulfing pattern appears when the price opens lower than the previous low, but buyers are pushing the price up to a higher level than the previous high, creating some juicy profits for the trader. The trader could enter a long position. That means we are gambling. I say gambling, but we are betting, we are hoping, we are saying that a long position says that we're going long, we're going up. Or we can take in a short position, which means that we are saying that we're going down. We're betting on the price going down. So entering this long position with the price moves higher than the high of the second engulfing candle when the reversal is confirmed. So we've got what's called a doji here. This represents a little bit of indecision. We see we could kind of even there. There was equal amounts of buyers as there were sellers, and we've kind of stagnated a little bit in the beginning here. So if we saw a doji maybe at the top of a movement, or anywhere really on the chart, we're like, all right, we're not quite sure now whether the bulls are in control, the buyers are in control, or the sellers are in control. We're going to wait for the next candle to tell us what's going on. And then on the next candle, we have bang, this big green candle. So the bulls have gone, stuff you bears, we're buying this up. So if we see something like this and then a big candle that's completely engulfed this one, it's a good chance that we might be starting to go up. This is a bullish engulfing. It's a far bigger green candle, far more buyers than what there were sellers and buyers at this point. So the morning star, this consists of three candles. This is, again, another positive indicator that we're going up. This is a bullish pattern. One short-bodied candle, a doji or a spinning top, which we saw just here. So it's sometimes going to look like this. Sometimes it might look like that. That may even be green as well. Don't always take them as gospel. You've got to be able to sort of scan it to understand and see an example of it to understand it for yourself. You're going to see lots of different types of all of these. So the doji, there was spinning top between a former bearish candle. So there was lots of sellers here, wasn't there? We saw all this bearish movement. We saw a little bit of decision here going, all right, we're not quite sure what we're going to do. Very much like this. It's almost like that, isn't it? We've got this doji or this spinning top where it's a little bit of indecision. We're not quite sure what's going on. And then bang, we've got all these bulls here, these buyers buying and bringing the price back up. So it shows that the sellers are drying up and that the buyers have taken over. The bullish candle overlaps with the body of the previous bearish one. So it's bigger, it's even bigger, and shows a fresh buying pressure and a start of a bullish reversal, especially if there's more buying volume. So typically when we see these big green candles, we're going to see more volume, buying volume, than we are selling volume. So 3 white soldiers. This pattern is usually found after a downtrend or a price consolidation. This means when price is traveling sideways without any clear indication that we're going up or down. That's what a sort of consolidation period means. It consists of 3 long green candles that close progressively higher on each close. So say, for example, we probably have a little bit of red here. So we've come down. We've maybe got a doji down the bottom here. Or we've got a small red candle. Then we've gone bang. We've got heaps of buyers here. Then the next candle has gone bang. We've got even more buyers here. We've gone bang. There's even more buyers here again. So this is a very good pattern to show us that the buyers are really in control here. And each candle opens higher than the previous open and closes near the high of the day. So if this was a daily candle or a 4-hour candle, for example, we've got 4 hours there. Over the course of 12 hours or 3 days, we've got great buying volume coming in. It means there's more buyers and there's more buyers and there's more buyers again. It's a very good pattern. So bearish reversals. This is obviously the opposite of bullish reversals. So we've seen a nice uptrend. We've got lots of greens telling us that we're going up. And then we've got these bearish reversals. The bears take over and we start seeing more of a sea of red than what we do green. Not good for us traders when we're looking for profits. So for traders shorting the market, which means that we're gambling that it's going down, it's equally as good. But in terms of longing and shorting and leverage, don't even concern yourself with any of that sort of stuff. The BitMEX, completely eliminate that from your brain right now as a beginner trader. It's not important right now. So for those of us who aren't playing with leverage, red candles are the last thing we want to see. Yeah, exactly right. We want to see more of the green stuff. We want to see the money, baby. We don't want to see the red stop stuff. Stop means exit the market. Game over. So bearish reversal patterns should form within an uptrend. Like what I said, we're going to see a period where we're seeing lots of greens and then we're seeing these bearish red candles. It's not a bearish pattern, but a continuation pattern. If we only see one red and we continue higher, that's fine. But if we start seeing multiple reds, yeah, we're in trouble. So most bearish reversal patterns require bearish confirmation. What that means is that they must be followed by more downside price moves, which can come as a long candlestick or a gap down in regulated markets, FX markets, and be accompanied by low trading volume. So if we've seen a red candle, then we see more red, more red, more red, more red, and lots of selling volume, lots of people selling their positions, then there's a good indication that we're going to continue that downward trend. But if we just see one red candle, like what we said, and then more green, that was just a little bit of a hiccup. That was a speed bump. So let's have a look at some examples of bearish formations. This is the bearish engulfing. So remember how we saw the bullish engulfing beforehand? Well, this is the opposite of that. So the bearish engulfing is the opposite of the bullish and is a very important candlestick formation for predicting price trends. It consists of two bodies, with the left hand candle being the previous bullish candle that is now engulfed by the bearish candle. So we got to wait for the close. That's a 4-hour candle. Then we wait till this 4-hour candle closes before we understand whether this is indeed a bearish engulfing candle. So you can see what's happened here. We've got a little bit of buys here. And then the bears rather have gone, nope, stuff you, we're selling it, we're driving the price down even lower. So the bigger it is, the more bearish the reversal. The red body must totally engulf the body of the first candlestick as it has. Ideally, the red body should engulf the shadows as well. So if it was a true bullish engulfing, even the wicks would fit inside the real body of the bearish engulfing candle. So a shooting star, this is almost like an upside down hammer, isn't it? The shooting star is made up of one candlestick with a small body. So the bulls were kind of working their magic here. We were going up. The price was driven right up to the top here, to this candle, to the top of the wick. So this may have been a big green candle at some point, and the bears have gone, nope, stuff you, we're bringing it down. So we're selling, we're selling, we're selling, we're selling, we're selling. And there's very small difference between the opening price and the closing price. So we've opened here, we've gone bang, we've come all the way back down and we've closed down here. So the long wick tells us that the sellers are taking over and driving the price down. Look for this candle at the top of an uptrend to signify that the buyers are losing control of a bullish trend. So you might see a bunch of big green candles, and right at the very top of the green candle group, we've got this one here, which sort of says, all right, well, the bears are in control now, and then we may start to trend downwards after that. So this is an evening star. Kind of saw this is like the opposite of the morning star, isn't it? Just sort of flipped on its head a little bit. This is a meaningful top pattern, meaning that there is there's a 3 candlestick pattern signaling a major top reversal. So that means that we've reached the top. We might have had a few bull candles here, the green ones. We've come up to the top. We've got this doji. What does that doji represent? Can you remember? Yeah, that's right. So it represents that there's a little bit of indecision in the market. We wouldn't buy on this candle because we're not sure whether we're going up or going down. So we've then signified here that there's a bearish candle, which says, all right, here at the end of this candle here, the bear started to regain control. So the larger this bearish candle, if it closes well into the body here, that's a good observation that, yeah, it might be time for the bears to start taking over here. So well done. I hope that didn't confuse you too much. Next week, we're going to dive right into the charts and really start getting into the weeds of some basic beginner TA. You know, you are now officially in the trading game and know the basics of bullish and bearish candles, as well as some of the more popular formations you're likely to see on your path to trading success. So don't just go out into the charts looking for those formations. That's just a little bit of an idea to sort of show you what candles are representing. We've got the big green ones, or we've got big red ones, or we've got small green ones, and we've got small red ones, and then we've got the wicks, and we've got the real bodies. You've kind of got to understand that before you can look at a chart and know what's going on. So then next week, we're going to dive right into the good stuff, all the juicy stuff that's really going to help take you to some trading confidence. Thank you so much for being a part of this series, and then we'll see you next week.